You're welcome to the Economy and Politics Conversation. I'm Ottoabasi Abasiekong. This edition will discuss rethinking banking in Nigeria for inclusive economic growth. My guest is Mr. Tosin Ige, the Head of Research, Proshare. Great to have you, Tosin.
Thank you for having me.
Thank you very much. Last week, Proshare launched the 4th edition of the Tier 1 Banks report titled Getting Bigger, Braver and Dominant, the Class of 2025. This will form the thrust of our conversation today. Let's begin, Tosin. Congrats again to Proshare for the 4th edition of the Tier 1 Banks report.
Thank you.
Consistency is quite remarkable. But let's first begin with the full capture of the year 2024 performance of the banks through the Proshare Bank Strength Index. It showed that the FUGAZE are back on course as Tier 1 banks, talking about First Holdco, United Bank for Africa, GTCO, the Zenith, and also Ecobank Transnational Incorporated.
Yeah. Okay, so the FUGAZE, as you mentioned, are the, without the he, are the traditional Tier 1 banks,
Yes.
which they are known for their large assets and, of course, their large capital. But one of those things we have set out to do from the Tier 1 bank report is actually to do a more robust analysis of the Tier 1. So going beyond the capital, the asset size, and of course the capital to actually arrive at those who are really the Tier 1. And so we did that robustness with more of total asset, capital, efficiency, risk management, governance. You see, it's more like an expanded matrix to rank the bank. And of course, we found out that at the end of using the model, which we call the Proshare Bank Strength Index, at the end of it, we were able to come out with the FUGAZE. So with the he now as the Tier 1, meaning that the First Bank, UBA, GTCO, Access
Holdings,
Zenith, and ETI now. So ETI being Tier 1. And what we find out is that, as I said, the traditional one would suggest that with your assets and then your capital, you're Tier 1. That's why, because those traditional Tier 1 have that capacity. But we have set all the bank with that matrix. Even when you had total asset alone, you find out that ETI is actually that strong in terms of total asset.
Pan-African financial institution.
From the individual metrics alone, we find out that ETI has the largest asset size, about 43 trillion, compared to Access Corp, which is next in line, that had about 41 trillion. And yes, it is because of their Pan-Africanism, as you said. But, you know, almost all the banks too, we use their financial holdco structure. So, and of course, you know, many of this bank, their financial holding company structures are more Pan-African now. Which one do you want to talk about? Access is Pan-African. FVNH is Pan-African. UBA has always been.
ETI.
So that's why ETI is in that category based on what we find from the Proshare Bank Strength Index. So that's why we arrive at that FUGAZE to say the Tier 1 banks are FUGAZE with the he.
Yeah, quite interesting that at least you talked about the expansion. I know we had a conversation with a bank leader who said that we need more strengthened policies to encourage Nigerian banks to expand across Africa. Quite interesting. You were rightly quoted while you had the banking report launch, where you talked about the fact that amidst the global economic uncertainties, the decisions that we take in 2025 will shape 2030. And that has to do with the current state of reforms we have in the country. Just last week, we marked Democracy Day.
What we're saying basically is that the current macroeconomic environment is the outcome of the choices we make as recent as 2023, 2024. And as such, the outcome we want to achieve in 2030, which is the $1 trillion economy, will be a function, or is a function of the choices we make now. And as such, we need to consider what the global economy is saying, what the African economy is saying, and of course, our domestic decisions. From the global economy, we have said two things are currently defining the global economy now. We have geopolitics and geoeconomics. And what this has largely created is uncertainty for the global economy. And because of that, our individual countries are not able to plan in line with the global economy. So everyone is still trying to get themselves right in order to set what and understand where the ball will turn for the global economy. So when you look at African economy too, because AfCFTA, which is the African Continental Free Trade Area, is meant to be the unifying factor for Africa. But because that agreement is yet to take shape or trading is yet to start under that particular framework, we see individual making plans for themselves, maybe bilateral arrangement with some other country, or some even trying to resolve their domestic issues. So again, countries are not able also to depend on the continental framework for their plan. And so you are having to plan yourself as an economy. The same is what we're seeing for the Nigerian economy now. We are having series of reforms in order to set our economy right. And from our own review, the macroeconomic reforms that have been launched have largely created relative stability and growth for the economy. But the point is that the same cannot be said for the micro. Now, we have said that the micro segment is the common denominator of any policy. Now, what we observe is that, yes, growth is, we are recording some growth in the macro, inflation is stabilizing, and then, PMI is above the 50-point threshold. But when you look at the micro segment of it, either from the household demand growth and even the consumer confidence index, which you can use to proxy the micro, they've largely been in the negative territory, which suggests that while the macro is recording that stability and growth, the micro segment is still in a pain point.
Yes.
But yet, we understand that it is the difficult phase of a transition period. But when will that transition, when will it end? When will it turn to benefit for the household? Is what remain in limbo depending on the choices we are making now. So that's basically how we contextualize the macro environment.
Definitely, because no matter what you do in micro, it doesn't transmit to impacting the micro, cost of living, all that.
Which is the household and the SMEs. They are the receiving end, they are the macro.
The real sector. Now, Proshare proposed that as we look at an economy as a country, we calibrate it to 14 economics, sectors that are critical to powering growth. So what will be the role of the banks post-recapitalization in supporting? Because what we've learned recently, discussing with some bank leaders, is that the role of the bank is to support.
Exactly. Growth. So we wanted to say that either pre or post-recapitalization, the role of bank remains the same, to support growth and stability of the economy. So having said that, but what we now tend to do is that the 14 activity or sectors that we currently have from MBS doesn't allow for a streamlined governance or accountability of our sectors. And as such, there are several things that go to play without really contributing to the economy. But we're saying, let's simplify the process into 14 sub-economies. So they are distinct, is that you pick agriculture, you pick energy, or you pick so it's defined, creative economy, blue economy. Let's streamline it. And our vision is that with this, we will have a focused development effort. And then we'll also be able to optimize resource allocation. And in doing that, because you've simplified the sectoral classification, bank have their work cut out for them. So it's not like one of those things. When we were reviewing the reports, we did the sectoral exposure of some of those banks to different sectors. And then, we've seen some of them investing in general commerce, from general commerce to general. You see, from you just see funny sectors, and you're wondering, how does this align with the aspiration of the government? Because what we are looking at is that we said now that banks are supporting the growth of the economy. Now, if the sectors that banks are lending to are different from the priority of the economy, then there is that misalignment that will seem as if bank may be running their own, profiting, declaring 1 trillion in profit, while the economy is going on its own. And so there is no alignment. That's why we said we can actually simplify the process and create that alignment that will create a marriage that will give us the the supportive role of the bank that will make it so obvious that it will be streamlined and then we will profit from it.
Yeah, very, very important. Very, very important. Focused development targets like that. Now, you also propose equity-based financing, which is also a very good recommendation. And a market leader at the report launch said, let this be a linkage with the capital market. Yeah. What is your take on this in terms of achieving long-term financing to address socio-economic issues in the country?
Okay, so in terms of the equity financing, we, as one of the proposals we made in the report, what we're saying basically is that the current administration has talked about not depending so much on debt. Yes. But we've also seen again that our debt level continue to rise nonetheless. Maybe, as somebody said, we've find some creative way to also finance, which eventually they are debt. What I mean creative way, I mean the likes of the guarantee or securitized or collateralized contracts that are based on maybe our government-owned enterprises or PPP, which is what we saw from the likes of the crude back loan that we launched. So all these are still debt. And what we're saying is that let's look at the equity financing. Now, Sukuk would have been one of the innovative way for this, but we found out that even the model of Sukuk we're running is not, it's not really maybe in line with the original idea of the Sukuk, because we shouldn't be having rental.
Compared to what is happening in Saudi Arabia.
Yeah, we shouldn't be having the rental. It is maybe you have an infrastructure that can be towed. You understand? So you finance it with Sukuk, then the proceed you are making from that towing the road or the infrastructure, then it could be shared at the end. So you understand? So that kind of model. And another model we're looking at is government investing in viable company. Yeah. Maybe their contribution could be the land. Do you understand? Their contribution could be the land for that businesses. And another one, it could be the incorporated joint venture, the likes of what we saw with the NLNG. So these are alternative, and we may not be able to go into details here, but there isn't any project that you bring on the table that you can't use an alternative finance for. Private equity is there. There is so much liquidity in the system. Even concession is another thing you can actually use. So these are opportunities, these are alternatives that we can explore, because the more we go into debt, the more the rate keeps going up. And of course, your debt service continue to increase. So which
impedes revenue.
Exactly, which takes more from the revenue. What you're actually supposed to have to finance other projects, you have to be paying it in debt service. So let's look at alternative. And that's why we've said, we started from the fact that we can first delineate the sectors into 14 sub-economies. So to streamline the financing of it.
Very interesting. And as we wrap up, what should we expect the banking industry Tier 1 report in the future, and what are the trends to watch and look out for?
Okay, for next edition of Tier 1. Okay, so a number of things that we need to look out for, and one of it is that the current report is in the first year of the recapitalization of the bank. Yes. So by the next edition, the recapitalization should have wrapped up. So that's one of those things we'll look at, is the full review of the playbook of the recapitalization. So we'll look at that, and again we'll also look at the industry capital size vis-a-vis the economy. By then, we understand too that the NBS should have released the rebased GDP, so that gives us the extent of the GDP we then have. So we'll be able to juxtapose them with the capitals of this bank to see the buffer they have in supporting the growth to the $1 trillion economy that we're targeting. So we'll do that in Naira and in dollar terms, so we'll also be able to make comparison with the African peers. And then we will also explore the recapitalization of the industry as a whole. Don't forget, one of the arguments we have made is that we believe that the recapitalization of the current commercial and mortgage bank is a first step to many many in the industry. So because we're expecting, the BDCs have been told to also recapitalize. So we expect the insurance have also more.
So you look at the broader financial services industry,
the recapitalization
which is very critical
of the entire industry. So we also review that in order to set the industry to support that growth. Because as I said, we are looking at how the bank can support the economy. So those are some of the things we look at in the next edition of the report.
Yes. Thank you, Tosin Ige, Head of Research, Proshare, for this interesting conversation on rethinking banking in Nigeria for inclusive economic growth. And once again, congrats on this very, very robust and incisive report launched by Proshare last week, titled Getting Bigger, Braver and Dominant, the Class of 2025. Of course, a lot to unlock from it. Thank you once again.
Thank you.
So our viewers, if you want to get further insights on this conversation, visit the Proshare website displayed on the screen and follow our social media platforms to engage further. Also, I encourage you to log on to our website and read this very incisive report on the banking sector. Once again, the report is titled Getting Bigger, Braver and Dominant, the Class of 2025. It's a report that is very incisive and enlightening for how the banks can reposition to support economic growth. Until you come your way again, enrich yourself with knowledge of socio-economic developments around you, it is wise. I'm Ottoabasi Abasiekong. Thank you for watching and bye for now.